Equities. Rahul, good morning. Itching to ask you on CCL products actually. It's a stock that's done well for you, but numbers clearly said that there's a bit of a problem.
Yeah, no, I don't think there's a systemic problem. I think if you analyze the numbers in detail, there was a bit of shift in inventory that was supposed to happen. I mean, there was a certain amount of inventory to be shipped out from Vietnam in this quarter. That will now get shipped in this quarter. I'll just take you back to Q4 of FY15 versus Q1 of FY16. Q4 was also actually a miss for CCL, but that revenue got booked in Q1. So I think it's just a logistical issue that he's not able to ship out the stuff on time because the lead distance from his plantation to where he actually ships it out is a bit much. I don't think there's anything wrong with the company. He also gets an export incentive from the government. He got about 7.5 crores last quarter, which was down to 2 crores this quarter. So that's an extra 5 crores which we'll get in Q3. So Q3's number should actually be good. We're not too concerned. I think we're still advising people to buy it. We still think you'll get a 38% earnings CAGR over the next 2 years, FY15 to 17. And the good part, Anuj, if you see the consolidated numbers, the interest cost has gone down by 20%. And that goes back to our original thesis when we spoke about when we were expecting him to generate about 250 crores of free cash flow the next 2 years. So 10% ROCE improvement. 250 crores of free cash flow, 40% earnings growth. I don't think 1 quarter of a deferment of what he was supposed to get really materially changes the course.
Okay. What's your target price then?
I think we're about 25% higher, Ekta. We're still flirting with whether we can value this as an FMCG company because it's going at about 15 times FY17. Some institutional investors still, go back to thinking about this as a commodity company. So we're not too sure. It's probably going to be a multiple expansion if we, basically decide to opt the target price. But at current prices, it's about a 20-25% upside.
Okay, that's on CCL products. But you have a view on the cement space. Which are the stocks that you like the most and why?
So we have a non-consensus call in the large cap space on ACC. It's not a consensus buy. That is something we like, and that's for 2 reasons. One is if you go back to September of 2013, the ACC and Ambuja had announced a restructuring because Wholesome globally needed cash, and the 3,000 crores of cash of Ambuja was likely to go to Wholesome. Subsequent to that, Wholesome and Lafarge had a global merger. So I think the strain on ACC's capex sort of not getting announced goes away. We're actually expecting ACC to report a 7% volume growth in the next 2 years, which has been virtually absent for ACC for a very, very long time. It's coming to you at $103 EV per ton. That's a substantial discount to Ambuja or even Ultratech. And if you actually see the operational parameters, which is coal consumption, fuel consumption, electricity consumption, it's actually doing far better than Ambuja over the last couple of years. In fact, 2 of ACC's plants figure in Wholesome's 15 global highest efficiency plants. That's how well ACC has done over the last couple of years. For a large cap stock, we have a 25% upside. It's a liquid stock. I think it would definitely be worth an investment. From the mid cap space, we like JK Lakshmi Cement. I think that's about a 25% upside on that stock as well. Capacity is doubling from 5 to 10 million tons. And in the smaller ones, we like Mangalam Cement. We think you're probably going to get a 65% earnings CAGR over the next 2 years. 5% ROE going to about 15-16%, about a 25-30% revenue and earnings CAGR. That's because the volume growth is going to be 15-16% over the next 2 years because they've just finished capex. So I think these are probably our top 3 picks in the cement sector.
Okay, so that's on cement. Let's talk about some mid-cap stocks and 2 stocks that you are bullish on. One is, of course, Parmac. I haven't heard too many views on that, so it will be interesting to hear your view on that, and Swaraj Engines.
Right, so Parmac, I think we're the only guys who cover it. It's a recently listed issue.
Yes.
I think the current price is trading just a little under the issue price. It's an interesting model from the point of view, Anuj, it's not a manufacturing company, it's a service provider. So they have 2 businesses. One is ETC, which is erection, testing and commissioning of BTG and BOP plants in India. So just to give you an example, 16 of the 21 supercritical projects in India have been worked on by Parmac. Both the ultra mega power projects have been worked on by them. They get 1 out of every 2 orders of BHEL and 1 out of every 3 orders of NTPC with a 38% consolidated market share in the ETC and in the operation and maintenance division. The O&M division actually gives them 20% plus margins, and by FY17 we think more than a third of the EBITDA will come from there. 25% return ratios, 110 crores worth of free cash flow the next 2 years with 120 basis points expansion and margin coming to you at 7 PE. I think it's a great stock to be had because it's not a manufacturer. It's one of those rare service providers in that space. On Swaraj Engines, we're taking a call that the tractor industry is in the process of bottoming out. If you see H2 of last year, tractors degrew by 30%. H1 of this year, they've degrown by about 18%. But if you look at Swaraj Engines' Q1 results, QOQ, the top line has grown by 50% and the margins have expanded by 300 basis points. That probably gives us an indication that the tractor industry may be in the process of bottoming out. Now, this is a company that gives you 35% return ratios. In the last 3 years, when the worst of the cycle is gone at 18 PE, we have just valued it at that. We're expecting a 300 basis point expansion in margins. We're expecting a 30% profit and EBITDA CAGR and a 20% revenue CAGR. So I think it's not a very expensive stock. It's a clean, pure play on tractor recovery in India. And I think if you're taking that call that, you're in the process of bottoming out, I think the stock could do wonders for you over the next couple of years.
Okay, well, I just want to tell our viewers that Power Mech O&M segment is the operations and maintenance segment that Rahul was talking about. Rahul, I wanted to ask you about the telecom space. There's so much news on Bharti today, as well as Idea because of the call drop issue. Have you managed to do the math in terms of maybe what or how the call drop issue could even impact the P&L?
No, Ekta, it's a sector we don't cover at all. I don't think the ROI from our business perspective favors it. There are not too many listed companies. I mean, Bharti and Idea are so well researched. It's not a view that we have on that sector.
Okay. All right. What about the auto space, maybe the auto ancillary space? You like anything from there?
So, I think, historically, Amara Raja, Excite and Vapco have done really well for us. I think the problem here, Ekta, is we're trying to see whether everything is priced for growth. That's the problem. I think if you just go back to this earnings season and not too far back, and you look at 3 companies, you look at TCS, Lever and Z, it's sort of giving you the indication that the market seems to be priced for growth. And there's not too much room for a valuation mismatch compared to what your earnings growth is likely to be. I think auto anchors are probably in that phase right now where they've done so well over the last 2 to 3 years that I think first the growth will have to come in the OEMs and then it will have to be in the auto ancillary. So I don't think there is any tearing runaway buy that we have in the auto anchor space. The only 2 stocks in the entire sector that we can give a buy on at this price would be Hero in the large caps and Swaraj Engines. Those are the only 2 that we have in the auto space.
Okay. 2 stocks that you are extremely bullish on, do you think they've bottomed out? Just Dial and Bata?
So, Anuj, actually, coincidentally, I just had a meeting with the new management of Bata. Well, the CFO has just been replaced, and so I had a chance to interact with him. I get a sense that this is a great stock to buy and hold for a very, very long time, but that does not become a retail stock. I don't think the stock will give you returns for the next 12 to 15 months. I think there have genuinely been issues. I don't think you can just go on blindly supporting a stock if there are structural changes happening. I'm not recommending a sell. I don't think this is at best a capital protection stock. I don't think you lose more than 10 to 15% on the stock, but to make money, you'll have to take a very, very long-term call, Anuj. And as analysts, we're not allowed to roll over too far into 18, 19 and that kind. But I don't think it's a great stock that will give you more than 15, 20% over the next 2 years. So I think there'll be other opportunities. On Just Dial, Anuj, in fact, again, we met the management recently. I don't have any problems with their core business, but I just think they've gone a little late into the Search Plus business. You look at Practo, you look at Zomato. I mean, you look at N number of apps that have come in, and what Just Dial wanted to do a year back, a lot of guys have sort of come in and done that. That's not to say that Just Dial will not meet success or perhaps even go out and acquire. He's a very, very healthy cash generating company. So if you look at our numbers, we still have a 25-30% growth on top line EBITDA and PAT for the next 2 to 3 years. Valuations are definitely more in favor of buying the stock today than it was probably a year and a half back. This is not going to test you for time as much as Bata will. You may get faster returns in it. But do I have the same conviction on the stock that I did perhaps a year back on both of these? Perhaps not. But like I said, I don't want to say that these are sells today. I just don't think they'll probably make you a lot of money over the next 12 months. But, if you are an institutional investor and have a longer term horizon, which is something more than what retail investors have, it could be looked at.
Okay, fair enough, Rahul. Any disclosures on all the stocks you spoke about?
No personal holdings in any. I think, if I'm not mistaken, one of my sister firms just has a marginal holding in CCL products, but that again is not more than 1%.
Okay, fair enough. Thanks very much for joining in and talking to us. So that is some fundamental stock picks coming in there. Time for a break, but we have an interesting boardroom lined up today. We have Ajay Agarwal of CN. That stock is down 10%.